Let's talk death insurance. You know someday that you're going to die. And so we're not going to use the euphemism of life insurance when we're talking about something that we're insuring that really is your death. Today, we're going to dive into the different pieces of this, what types of coverage there are, why you might or might not need them, and how to think about it generally.
So Spencer, today we're going to talk about death insurance, also called life insurance, but by and large, it is death insurance. We're trying to protect against an untimely death. So we think about people that are early in life, maybe have a family, they want to protect their spouse, their kids for a long period of time. So as we think about life insurance, death insurance, what are some key things to know as just kind of an overview of life or death insurance?
Well, I think you raise an important point, actually, an untimely death, and we should say this even at the start, which is if we have some kind of terrible Armageddon type of situation, that doesn't cover us. If we have, warfare, or we have a situation where we have even a pandemic, some coverages don't cover that. Mm-hmm. So we need to think untimely death, and we need to understand that there are provisions just around that piece. What we want to come back to is not everybody needs this type of insurance for a couple of different reasons. First, we come back to that original question of what is our financial plan looking for as our goals? And if there's no goal that insurance would cover, if you're single and you don't want to leave a large estate necessarily to a charity or loved one, you might not need life insurance. Mm-hmm. If you've already saved a tremendous amount, you may not need life insurance on that side of things. We always joke that Bill Gates is probably not buying life insurance at this point because insurance companies are good at making money. So on average, they're going to make a little bit of money on everybody. Now, for some people, they're going to lose a fair amount of money because there's an untimely death. For a lot of people, they're going to make a little bit of money on those policies, and they price it accordingly. So if we don't need insurance, we don't want to take that bad statistical risk and pay an insurance company for something, again, that is not going to be as useful to us.
Yeah. And so as we think about the parties that are involved, you've got the insured. So if you and I entered an insurance contract with a third-party insurer, if I took the policy out on your life and I said, I want money if Spencer dies, you would be the insured, I would be the owner of the policy, and then I could also be the beneficiary. The beneficiary is going to be the one that receives the benefit, and the insurance company is who I have to pay so that if you die an untimely death, then I will receive the lump sum. What are some other insured cases that we want to consider?
Well, one of the things that we also want to recognize is you have to have an insurable interest. The insurance company is not going to just let you take out a policy on Joe from California if you don't know Joe from California. Yeah. You need to be, say, a spouse or business partner or someone related to them who has a reason for taking out that policy whereby you would be harmed financially in the event of that person's untimely death. So we think about this, and a couple different things that we need to remind ourselves. First, there's a death benefit. Mm-hmm. In the policies, there is a face value. Sometimes that face value amount will move up based on the amount of investment that can be put into a contract. Sometimes that face value does not move, say in a term type of policy. There's premium that's paid typically over the course of time. Sometimes that could be monthly or quarterly or annually. Mm-hmm. Depending on the different types of policies, that may also fluctuate over time. So we'll dive into that. And there's 3 different types of policies that we really want to dive into: term, whole, and universal life policies, and we'll address those accordingly.
Great. So let's go ahead and dive into term insurance.
So when we're talking about term insurance, this is the cheapest type of life insurance that we can get for the amount that we pay.
Yep.
So that face value, we get as much as we can of being able to protect against our death for the amount that we pay. So it can be a rising term level where we're paying a little bit more every year, or it can be set. And typically we're looking at something like 10, 15, 20, even 30 years of that term insurance because we want to lock that in over a long period of time. So oftentimes we would have a circumstance where we have a married couple and they know that they need some insurance, and so they buy term insurance for 30 years because they think, well, if either spouse passes away and maybe they have kids down the road, they're going to be insured through the event of an untimely death in that way. If we think about that death benefit, it doesn't change. So usually we want to buy enough there such that if we have certain events happen, if we have another child, or if we have some unexpected expenses come up, that we've got a little bit of buffer in there based on what we might need. Another thing that we want to think about is the financial strength of the insurer, and we would say this for whole life or for universal life as well. We don't want to be working with a company that is not strong financially, because they're going to need to be around for 20 or 30 years. They need to be there such that, heaven forbid, you're 28, you pass away, they're going to be good to be able to pay off your spouse or your loved ones, your beneficiaries there. I think the final thing that I'd pay attention to in terms of term life is this idea that companies will come after you. There's kind of a gotcha in here. It's a little bit like this extended car insurance, extended warranty car insurance that we see. You may get phone calls on a day-to-day basis, emails, all kinds of different mailings to you, and it's because people know that they can make a tremendous amount of money, companies do, in this space. So we want to be really careful, because usually with term life policies, companies will be reaching out to you and saying, hey, why don't you convert this to whole life, because they make a whole lot more money in whole life. So I probably get every other week on average, I'll get a mailer that says, hey, why don't you convert your term life policy to whole life insurance? So this is usually a really bad idea. There are a few circumstances, of course, where it could be a good idea, but generally speaking, it's not a good idea to make that conversion. Something to be aware of.
Yeah, so let's go ahead and jump into whole life. So the difference between whole life and term is, well, first, the premium is going to be a whole lot higher because they're thinking that's a long-term investment. It's not just insurance, it's insurance with an investment component. So you've got the death benefit, but you've also got a cash value. And that's why the premiums are more expensive, is that you're trying to invest over time. The policy continues to rise in value per se. But oftentimes the premiums are just outlandish. I remember when we were first looking at life insurance and we were talking to our agent, and he was saying, oh yeah, you should look at whole life. And I looked at him and I looked at my budget, and I thought, this will take up my entire budget and I will not have money for groceries. So why are you even trying to tell me that I should look at whole life? As long as you pay the premium with most of these policies, they're going to stay in force. You have to continue to pay. However, with whole life, one of the benefits is once that cash balance can cover the premium, then you don't have to keep paying those. But that could be 10, 20, it could be a very long time before that balance gets to that point where you can then not have to pay your premium anymore. Another benefit of whole life is that you can take out loans against the policy. Now again, if your policy only has $100,000 and you take a $50,000 loan out against it, well, if you die 2 days later, then your beneficiaries don't get that whole $100,000. They only get the $50,000 because the insurance company is going to recoup their loan that they gave you. So you just want to be aware of that if you have a whole life policy. You can take a loan out, but we wouldn't recommend it. Finally, there's types of whole life policies. Most of them just allow you to invest that cash balance in an interest type environment. So it's kind of like a bond purchase. It's only going to increase a little bit over time. But there's other types of policies like variable whole life that allow you, the investor, to choose the investments that you want the cash to go into. Now there's downside to that, because if the policy goes down, then your cash value goes down if the investments go down. So let's talk about the last type, Spencer, universal life insurance. What do people need to know about universal life insurance?
So universal life insurance, you basically have the side of things that is the cash value and then the death benefit, and they're separate, in some ways. And so this gives a little bit more flexibility in terms of the premium that's paid. Oftentimes we'll see situations where this universal life policy might be best if you have a situation where you want to overfund the policy early and see that policy grow in terms of its investment value. There are ways that at a later point in time you can take those loans that you talked about, and if you've invested things really aggressively and you take the loan, then that is a tax-free distribution. You've got to be really careful with some gotchas in there, and so oftentimes we don't think that it really makes sense to go that universal life policy where we're really overfunding it, but there are options in terms of how you do that. But again, we've got those two pieces split out, and we've always got to have enough on the investment side of things to be able to plan for the policy premiums over a long period of time. We don't want to get to a point where the policy lapses, because then if we've taken a loan, then we've got some really negative tax consequences that are not fun to deal with. So it's a more flexible type of policy than whole life typically is, because you have more investment options typically there on that side of things, but there's still a lot to really consider there. When we think about death insurance, we really often go back to just the term policies, trying to make sure that that is put in place, that there's enough before we really think about either whole life or universal life. And it's usually a fairly unique situation, let's just say, for whole or universal life to make sense. And we've usually filled up things like a 401k and other types of investments, Roth IRAs and those kinds of things, before we really think about overfunding universal life policies.
Yeah. So maybe what are some of those instances where a whole life or a universal life makes sense? Because, you know, insurance companies are going to come to our clients and they're going to say, hey, you should buy this. So what do they need to know of when is it valuable to purchase those types of insurance?
Well, it can be valuable if we're looking at a situation where there's a significant estate or death tax that may be on the horizon. Maybe there's an illiquid holding. Person owns a company that they really don't want their heirs to need to sell, so they go and they buy some whole life or universal life to be able to have a high face value, to be able to have that pay off when they pass away, so that the estate can pay the taxes there. So that would be one circumstance. Again, that's not very common when we think about the grand scheme of things of our population, but for a few people that makes sense. It can also make sense if we've checked off all of the other buckets in terms of how to save. And we think about maybe overfunding a universal life policy just with the idea that down the road there could be withdrawals taken, loans taken from the policy without the policy lapsing, because that can be a tax efficient way to go. But again, there's a whole lot of other ways that seem like they have fewer headwinds and fewer gotchas to be able to navigate there.
Okay, so let's talk about the actual needs that people have when they are covering for death insurance. So what do clients need to think about? What kind of buckets need to be filled in those different stages of life? So let's maybe start off with just the basic rule of thumb. What should people cover?
Well, if you go to the financial media, you'll see articles that are written, and some of them would say, well, a rule of thumb is 10 times your earnings, or 10 times your earnings plus any debt that you have right now. So maybe you would cover student debt, you'd cover a mortgage debt, and then 10 times earnings. And those aren't bad places to begin a conversation. But with something that's this important, we really want to think about the obligations that each person has. As we talked about, some people don't need death insurance at all. For folks that need death insurance, we want to look at the trajectory of that need over time. So two quick examples here. Let's just say we've got a couple that was recently married, and they found out that they're pregnant for triplets. Dad is a physician, gonna make a couple $100,000 a year, and mom wants to be able to stay home. They have $150,000 of expenses, projected. And so they think, well, maybe we need this for 20 years. And maybe, because mom's going to be home in that time, if dad passes away, she needs funds to get out to actually Social Security. So we think another amount there, maybe $70,000, after the kids are out of the home. So that might be a policy if we think about just math, 20 years potentially times $150,000. And then we think about $70,000 a year after the kids maybe are out of the nest. At 15 years, that's about a $4 million policy. That's different than that 10 years, rule of thumb. That's almost double that, basically. The flip side would be, let's say we have a couple that they have 7th and 8th grade kids, and they each make $60,000 a year. They're both teachers, let's just say, and they've built their budget around this. If one or the other should pass away, they might only have 5 or 6 years with kids under the roof, and they might say, well, we really would probably only need about $30,000 a year to replace that income and kind of the offset of expenses. So maybe that's $150,000, and let's say, well, we need another $100,000 to be able to put the kids through school in college. So that might only be $250,000 if they don't have much debt from student loans or from a mortgage there. So it might be, again, very, very different than that 10 years worth of earnings, which would be more than double that. So within a situation, there can be a lot of different things that we want to consider. We really think that it's important to tailor the amount of insurance based on the need, based on the goals. Because again, we don't want to buy too much insurance. We don't want to over-insure because the insurance company is probably going to make money on each policy. At the same time, we don't want to under-insure, if at all possible, because we don't want to put our loved ones in a bind should we pass away.
Spencer, thanks for walking us through just those different scenarios and what needs people have and how they can be different for different clients and different individuals. So for clients, we can't sell you insurance policies. We're not licensed insurance agents, but we would be glad to review policies that you do have, give you guidance about maybe what are some next steps that you can take and whether you need to keep those policies in force. So talk with your agent, talk with your financial advisor, and we hope you enjoyed this video, and we'll see you again next time. If you found this episode valuable, share it with a friend and subscribe so that you don't miss the next episode. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.